table of contents. Slide 3 is the overview, done by Manuel. Slide 4 is the history and rise of the business, done by Julie. Slide 5 is issue 1, flawed business model, done by Nabila. Next is slide 6, which is the second issue, marketing campaign, done by Sophia. Next slide, slide 7, is the third issue, which is online retail model, done by Leaf. Slide 8 is the downfall, done by Jose. Next is slide 9, which is purchased by PetSmart, done by Emily. Next is slide 10, which is why they failed, which is done by Chris. Next is slide 11, which is the possible solutions, done by Emma. And lastly, we have slide 12, which is the bibliography.
Hello and good morning to everyone. We are group number 1 of the group projects. Today, we will be discussing the rise and fall of the online pet retailer, Pets.com. Our topics will include the history of the company, some key issues Pets.com had, their quick and rapid demise on November the 9th, 2000, what happened to the online domain, and some possible solutions that we as a group think Pets.com could have done better. The online domain is a perfect example of how an excellent idea can quickly perish without the proper allocation of resources, a lack of planning, and a faulty business model.
Pets.com was a pet supply website where customers could obtain pet supplies such as food, accessories, and much more. The company was founded in 1998 in San Francisco, California. The majority of the venture capital financing received by the company was used to build warehouses and other shipping infrastructures. Pets.com earned $900,000 in revenue and spent $11.8 million on advertising. The regional advertising campaign included television, radio, print, outdoor advertising besides their Pets.com magazine. In an effort to save expenses, they located their customer labor team to Indiana. While Pets.com offer was rejected, in December of 2000, parts of Pets.com assets, including its domain, trademarks, and businesses, were sold to PetSmart. Pets.com domain redirected to PetSmart.com as in 2022.
One of the first issues Pets.com did was that they failed to focus on creating a concise business model. They did this by focusing on building the product before actually looking into its market, and also by having no revenue plan whatsoever. They forgot expenses such as the retail shipping, the warehouse, and competitive market costs. Additionally, the company completely disregarded appropriate price margins. They did this by selling the products for a third of what they had spent to obtain them, and also by offering huge discounts and free shipping, which took huge sums of money away from their business, since shipping itself was pricey for pet products because they usually were heavy and bulky.
Pets.com spent millions of dollars attempting to make their brand widely known through the use of a sock puppet mascot. This mascot worked, and it even made an appearance in the annual Macy's Thanksgiving Parade. However, they also spent ridiculous amounts of money on high-profile advertising, followed by lots of online, print, television, and even radio advertising. Some sources say that the company spent around $1.2 million on a TV commercial for the Super Bowl. The IPO that the company had raised earlier of $82.5 million was quickly gone, and it is said that the company spent around $70 million in advertising from 1990 up until their downfall. One of their biggest mistakes that could have been fixed before they spent all of this money on marketing was that they should have done research to verify that there was even a consumer demand for this product that they were advertising.
One of the biggest issues that contributed to the failure of Pets.com was also what made it such a unique business at the time, its online retail model. The internet was in its early days, and most people were still getting adjusted to it, which allowed Pets.com to carve out a unique niche that it used to dominate its market space, though not for long. Pets.com didn't take adequate steps to integrate its customer base with the unique characteristics of an online retail store, which ultimately drove them away. Additionally, the online business model of Pets.com was in some ways too ahead of its time. There weren't options for the requirements of an online business, such as e-commerce, warehouse management, or customer service at the time. Given this, Pets.com had to do it all from scratch, with an engineering team of 40 people and intensive servers driving its operating costs through the roof. Between the lack of customer integration and its high overhead, Pets.com's online business model was a huge contributor to its downfall.
The downfall started with the company having very low profit and near no profit, along with not much revenue to cover the expenses, which meant that they were going into debt very early. Along with that, they had a long waiting time, like all order online stores have, and all the customers were like not happy with the waiting time.
At the beginning of its lifespan, Pets.com looked really successful. However, it quickly failed, and in lieu of not being able to find any new financiers, Pets.com officials had to start selling assets, which led to PetSmart purchasing Pets.com URL and other related trademarks. Due to this, PetSmart remains one of the most popular pets companies, along with its competitors Petco and the upcoming brand Chewy.
Many factors led to the failure of Pets.com, one being their lack of a revenue or solid business model when they first started their company. When starting, they made their products and immediately looked for a market to sell them in. Like many other .com companies in the late 90s and early 2000s, they had what was referred to as a back-of-the-napkin business model and ended up making an initial public offering virtually overnight. Stemming from their flawed business model, they didn't know how to compete with the other pet product companies. They focused their attention on selling low-cost products, which led to the companies selling their products below cost. Beyond this, they couldn't compete with pet stores and grocery stores where people could go and get the same products they had on Pets.com for the same price. Logistically, Pets.com failed to adapt and found a lot of difficulty shipping larger products such as bags of dog food. Even after Pet.com was able to lower costs and increase profitability, their high marketing costs were still pushing their stock price down below its initial value.
One possible solution for Pets.com, if they were able to continue with their company, would be to have a strong business model at the start. The business model was the domino effect on the downhill of the company. And the main red flag was that this business idea could easily be accessible by just going to the nearest grocery or convenience store and get easy and quick access to everything Pets.com was selling. They should have also incorporated a cost leadership competition strategy into their business model. This strategy hinges on a company's ability to lower costs of production to offer quality products at low prices. And in the early 2000s, Pets.com was one of the 5 .com websites with productions of almost 83 million in 1 month. So they were a large company. So this could have been way more effective.